It is Friday, which means it is time for Risk and Rewards. I'm Lisa Abramowicz with, of course, as always, John Authers. And we're here to talk about the topic of the week, the only topic of the week, even though it could have been Countdown to Jackson Hole, or perhaps interest rates are still low, even as they were last week. But really, the issue is that growth fears seem to be reasserting themselves in a more real way. And John, there's a question as to why.
Well, I think the one big reason is you spell it with a Greek letter rather than a Roman one, is delta. Obviously, that's having a broader effect on sentiment, i.e. it's making us all much less happy than we were a few weeks ago. It's a genuine downer, as I'm sure everybody watching this will identify.
Happy Friday!
Yes.
Go on.
And you have a look at the retail sales data that were surprisingly poor for the US, and you look at what's going on in China, for which Delta may be somewhat of an excuse as well as a reason. But if you look at what's happening in China, there are obvious reasons to think that we're not going to get, whatever kind of growth you were expecting a few weeks ago. You probably do need to count it down a little, and that does plainly begin to have an effect.
Yeah, well, let's stick on the China issue for a second, because I feel like something changed this week, and that really had to do with that Ningbo port that continues to be partially shut down, and the expectations are for it to remain partially shut down through the end of the month. And this raises me to want to bring in our expert on inflation and all things inflationary that indicate inflation, and that is John Authers. Thank you for being here. So you have this, inflationary indicator that you look at every day with a lot of different inputs. And there's a question about supply chain disruptions.
Yes.
How does that factor in when it comes to longer term inflationary impulses?
Well, you need to look at both, the economics 101 way to do is to look at cost push and demand pull. You could faintly begin to argue that this reduces demand pull, that we've now got the Delta variant coming around. But if you look at where the greatest signs of inflationary pressure are at present, they are more on that supply side of the equation. Producer price inflation is already very high in the States, and it has persisted for a while already. You also do see, while a number of the most, we discussed this last week, but you are seeing some of the less transitory items of inflation beginning to tick up, which appears to be a signal that there are problems in being caused by the bottlenecks. And if you take a look at what CEOs said in their earnings calls, the earnings season is pretty much over now. You've had a number of very interesting summaries produced of them. They're all kvetching about supply chain disruption.
That is a technical term.
It's a technical term. I've been living
lots of kvetching on those calls.
Yes, and by a bunch of fancies or whatever the phrase is, all of whom presumably are Bloomberg clients, so we love them even. Anyway, so they plainly there's
Friday, can you tell?
There's very, very great concern by the people who are actually running companies about this. Ningbo, I agree with you that if that is where you really do get to a black or white 180-degree moment. Either the port is open or it isn't, and the longer it stays closed, the longer it must take to rectify the gap later on, or the greater will be the pressure to increase prices while we wait.
You said a number of things. The first issue is the supply versus the demand-driven inflation. That basically there's a theory out there that if the supply chain disruptions are coming without demand increasing necessarily, then it has a sort of disinflationary kind of impulse, right? Because basically prices go up, but the demand to buy the goods isn't necessarily as prevalent. However, if we've had such an incredible demand for goods, then it's easier to pass along those infrastructure costs. And frankly, there can be a more persistent and long-lived kind of push in prices going higher because there are enough people to buy it with the money, thanks to a lot of the stimulus programs, to buy it. The issue that I have is, how long do these supply chain disruptions take to work out? And everything equal? Like, in other words, if we just pause the recovery now, does that mean that we'll get as much overall recovery down the line when you net in everything, or will you have less? Do the frictions matter? And I would argue from a sentiment-based level, what we're seeing on the margins is people are delaying or perhaps just canceling purchases of things because the prices are getting too high. We're seeing that in the housing market. We're seeing that in certain washing machine and other types of utility purchases. This, to me, is sort of the big question mark that remains to be seen, what I'm looking for in the upcoming data, which is how much are the supply chain disruptions and the subsequent price increases as a result of that leading to less demand, lower consumer confidence, as we saw last week, to signs that perhaps it is crimping people's desire to spend. And that, to me, I think will make a huge difference.
Yes, I completely agree with that. Obviously, one of the big ugly moments for the markets in the last couple of weeks was the consumer sentiment data from Michigan, which was actually, ironically, it's whenever a number is that shockingly bad and surprising, probably it does mean that it was exaggerated. There always is some noise in those numbers, but I'm sure it was directionally accurate that sentiment really has taken a serious knock this summer. People really thought they were going to be back to normal, and the degree of patience people have is diminishing. I think if you want to talk about it at a level that we care about rather less, but in terms of what it might mean for stocks, and their profits, one of the other things that's quite interesting coming out of earnings season is that there's a great deal of confidence from companies that they would be able to pass prices on, i.e. They were complaining bitterly about supply, but they were also pretty confident that they had so much demand that they could just merrily pass on the prices to consumers. So good news on growth, bad news if you're concerned about the possibility that the party really has to end because inflation comes back. I think this now begins to raise the possibility that it really is equities, that it really is the companies themselves that have to take the hit.
Maybe. Honestly, I'm going to play devil's advocate to myself here, because I would argue that on one hand, you could say that margin pressures are a serious issue. On the other hand, I was struck by Marty Walsh, the Labor Secretary of the United States, yesterday, coming out and saying that perhaps the Delta variant, if it continues, will prompt states to reinstate enhanced unemployment benefits that have run off.
Right.
What's the policy response if we end up with a pandemic prolonged as much and as deeply painful psychologically, emotionally, from a confidence perspective and everything else that it is? How much do those policy supports provide a buffer to the worst case scenario and enable consumers to keep spending? And that, honestly, I don't know how much pushback there would be, probably substantial, to reinstating any enhanced unemployment benefits at this point in the recovery, at this point in the pandemic, in response to the uptick in the Delta variant. However, the fact that there is such a ready appetite and willingness to step in, both either on the Fed part or on the fiscal part, at least, in some corners, highlights how much this cycle has changed and why people just keep going into stocks and keep going into riskier assets.
Okay, so I won't be a devil's advocate because what you just said was very interesting. I'll try to give my actual honest assessment of what you said.
Just be honest.
This is me rather than the devil and an angel on either side of me, like in the cartoons.
Okay.
I think what we have learned from the last 18 months is that state intervention, at least in the short term, because we don't know about the long term yet, but in the short term really can do a lot to cushion the worst economic effects of the pandemic. I think that's beyond denying at this point that it cushioned things to a greater extent than anyone had really predicted in advance. The question for the future, and this gets also into the whole issue of, can you invest in anything other than stocks? When can this logic ever end? Is whether this finally leads to more inflation, at which point something has to be done to force bond yields to go up, and the party quite possibly does end. Absent a return to the kind of serious inflation that gives the Fed no alternative but to really take the punch bowl, what you just said makes sense and implies a continuation of this sort of rather uncomfortable but persistent logic of, okay, nothing for it, guys. We've got to keep buying stocks. If you get what I mean, it's a continuation of the pre-pandemic logic as well, of a slow recovery that doesn't make anybody very happy. In which, if you have to invest in assets, it probably has to be stocks.
So one thing I really wanted to ask you about, John, was that we have these supply chain disruptions. We have higher sort of inflationary inputs as a result. At the same time that we're having growth fears, or at least not fears, that's not really accurate, but there is more of a threat to a deceleration in the recovery based on the Delta variant, with the number of downgrades to economic projections this week.
Yeah.
How does the Fed respond to this, right? I mean, they're going into their Jackson Hole next week. And how do they respond to both inflationary inputs going up, but that it is a disinflationary force at this very moment, not going forward necessarily, but at this very moment, based on where the pandemic is? What do they do with that?
Okay. I don't know. Neither do you. My best guess. I suspect neither does Jay Powell, but because it's a tricky one. If you want me just to try to infer what their reaction function, what behaviorally, in terms of behavioral finance, whatever, what they're most likely to react, I think they probably do mean what they say about unemployment mattering more than anything else, about getting the message that at this point we've reached a point where inequality really has to be addressed in some form, and where they really do feel that they're prepared to let inflation run hot for a while. To some extent, you could argue that Delta would make it easier for them to taper, because it makes it that much less likely that the bond yields would rise sharply. But it does also give them cover not to taper at all, to continue to try to get through to a point where they juice further. My best guess is that Jackson Hole is too soon now. Had there been no Delta variant, there would have been a pretty good argument to use Jackson Hole to unveil the new strategy in the same way that it was used to unveil FAIT a year ago. I think it's too early because it's still not clear exactly how big a deal Delta is. And they will want to be more cautious about doing it. So I think it probably means not next week.
I would just argue, and unfortunately we don't have enough time to really get into this, but the theme of the Jackson Hole event is going to be the uneven recovery. Yes. And the unequal recovery, to sort of speak to your point about employment and the unequal distribution of wealth in particular. And I do wonder, one of my biggest questions heading into that meeting is how they address their role in this, right? I mean, arguably they've been sort of foisted into a position with very blunt tools, and it isn't necessarily their fault per se, but by persisting with the $120 billion monthly bond purchases at this point, how much are they helping an employment situation that's completely removed from financial conditions, and how much are they just exacerbating a wealth gap that has gotten to the widest point, frankly, in the United States history? So these are some of the issues, or at least in recorded history. Some people will say Rockefellers, et cetera. But I will just say, in recorded history, I think it's an interesting question. We only have a couple minutes, though. What in the markets caught your attention this week?
The one that caught my attention most was the fall in Qingdao iron ore prices. That is not something you can attribute to what's happened at Ningbo. You would think, if anything, that would lead iron ore prices to go up. It's obvious that there's an awful lot less demand. For those who haven't seen that particular chart, they're down roughly 50% from their high earlier this year, and it's become really quite sharp, quite a rout in the last few days. As Chinese data goes, that's one of the most trustworthy pieces of data out there, how much people are actually prepared to pay for iron ore. And that suggests that there may be more of a, even excluding Delta, there may be more of a Chinese problem than some people have been realizing.
And I would argue you could see the potential for a Chinese problem, as you put it, on a broader scale, having different transmission mechanisms throughout the world, both from the Delta variant as well as in terms of their shutting down the part of the port in response to the pandemic and these cases, as well as some of the regulatory issues. I would just point out in the last 30 seconds, what I found most interesting was the dollar, and that the dollar strengthened versus its peers to the most since November. And this comes in a backdrop where there still is a net short position on the dollar. And I do wonder what would change this backdrop where the dollar is continuing to strengthen, because this Delta variant, frankly, and the lack of travel and the lack of an international economy affects other countries just as much, if not more, than the United States. So you do wonder how much this will really change at this point. That's my sense. In terms of a stronger dollar. Anyway, unfortunately, we're out of time. Have a wonderful, wonderful weekend. John, always a pleasure.